Hey everyone, welcome back. Today we're taking a deep dive into something that's probably on all of our minds, especially with, how the markets have been doing lately. We're talking
Yeah.
about market downturns. So how can we look at those drops not with fear, but as potential opportunities? And we've got some really great material to dig into today that I think will give us some new ways to think about all this.
Right. You know what's really interesting is that market drops are a normal part of market cycles.
Hmm. Hmm.
Like it or not, they're going to happen.
Yeah. So it's kind of like, I don't know if this analogy works, but when you're on a roller coaster and you know a big drop is coming, but you kind of are excited for it.
Yeah. Or you're not excited for it, but you know it's coming.
Right.
Part of the ride. You don't just like get off the roller coaster.
Exactly, exactly. Okay, but how do we train our brains to kind of see those dips as a buying opportunity instead of like, oh my gosh, the sky is falling, I need to sell everything. How do we get out of that?
Data. It really is all about data and understanding like the bigger picture of what's going on.
Oh, okay.
So like if you take the S&P 500, for example,
Yeah.
and you look at the chart over the long term, you're going to see those dips, and some are more dramatic than others, of course.
Yeah.
But the overall trend has consistently been upward.
So I'm picturing this chart in my head with its peaks and valleys. So really it's more about riding those waves over time rather than trying to perfectly time when to buy at the very bottom and sell at the very top.
Exactly. You got it. And this is where it gets really interesting. There's actually research from JP Morgan that found that investing at an all-time high actually led to better returns over a 1 to 3 year period than other entry points.
Really? That's so interesting because, and I'm sure this is true for a lot of people listening, we're always told buy low, sell high, buy low, sell high.
Right, right. It seems really counterintuitive. But that's actually, it highlights how our emotions can sometimes make us make decisions that aren't in our best interest.
Totally.
Yeah.
So, I mean, for me, when I think about that, I'm like, oh my gosh, I missed out on, buying at the lows. I'm not going to get in now because what if it keeps going up and then I buy at the very top?
It's FOMO, isn't it?
It is. It totally is.
Yeah.
Oh, that's so interesting. Okay, so it sounds like it's less about being a market wizard and more about having a solid strategy and sticking to it.
It's having a plan and sticking to the plan,
Yeah.
absolutely.
Yeah.
And, I will say this, not all market drops are created equal.
Right.
There's a difference between what's considered a correction and a full-blown crash.
Right.
And that's really important to understand because it can change how you might react when things get a little volatile.
Okay, so let's talk about that. What is the difference?
Okay.
Okay, so let's talk about that. What is the difference?
So a market correction, think of it like a summer thunderstorm.
Okay.
It's brief, it's
Hmm.
intense, maybe a little scary,
Yeah.
but ultimately it kind of helps clear the air a little bit.
Eh.
And usually we're talking about a drop of around 5 to 20%.
Yeah.
And they happen fairly regularly.
So those corrections are like a reality check for the market.
Yeah,
It's a chance for things to kind of reset a little bit.
exactly. And what it does is a lot of times it'll bring prices back down to maybe a little bit more realistic levels, and that can actually create some good buying opportunities.
That makes sense. Okay, but what about those full-blown crashes? Those feel way scarier than a thunderstorm.
Yeah, those are a little different.
Yeah, those are more like a financial hurricane.
Right. When we talk about crashes,
Hmm.
we're talking about those really big drops,
Hmm.
30, 40, 50% or more. Those are the ones that make the headlines and send investors running for cover.
Yeah, like back in 2020 when the pandemic hit.
Exactly.
I remember feeling like the world was ending and my portfolio definitely felt like it.
We all felt that way.
Yeah,
Yeah. It's a very emotional event.
it is. But here's the thing. Historically, if we look back, the market has been incredibly resilient, even after some of the most dramatic crashes. And that's not just me like, being optimistic, that's the data.
Okay, well, let's talk about that data then,
Yeah.
because I feel like so often when we can look at facts rather than our emotions,
Mhm.
it's a little bit easier to stomach.
Absolutely.
So, when we think about, how long does it really take for the market to recover from some of those big crashes, what are we looking at?
So there was one study that looked at market crashes going all the way back to 1960.
Okay.
And they found that 1 year after a 30% drop, the average recovery was 40%.
Wow.
2 years out, the average gain was 70%.
Wow. So what I'm hearing is that while those crashes are really scary in the moment, historically, the market has always bounced back and often even higher than before.
It's true. It's almost like it overcorrects. You know what I mean? And then it has to play catch up.
Yeah. Okay.
So, and look, that doesn't mean that, we're rooting for crashes.
But it's just a highlight that, they happen.
Yeah.
But understanding that historical context can help us make more rational decisions when they do.
So we talked about not fearing the corrections and then also understanding that historically the market has always rebounded from those crashes. But I think it's also important to kind of acknowledge that it's not just about surviving a downturn, right?
Right.
Like ideally we would thrive or at least come out a little bit ahead.
Yeah.
So what can we actually do to be proactive? I know one of the sources talked about this concept of pledging assets, which sounded really fascinating. What is that? So you're saying there's a way to actually use a market downturn to potentially boost our returns. I want to hear more about this pledging asset strategy because to me it sounds like something that like super wealthy investors would do. Is that right?
You're right. It is a strategy that ultra-high net worth individuals use.
Okay.
But it's not as complicated as it sounds.
Okay.
So imagine you have this really valuable comic book collection.
Okay, I'm picturing it.
Right. And you need a little extra cash.
Yeah.
But you don't want to sell your comics because you know that they're going to be worth even more later.
Right.
So you go to a specialized pawn shop, one that understands comic book value, and they're willing to loan you money using your collection as collateral. So that's essentially what pledging assets is.
Okay, so instead of pawning my comic books, I'm using my investment portfolio as collateral.
Exactly. So let's say you have a diversified portfolio of index funds, right?
Okay, yeah.
Instead of selling those during a downturn when prices are low, locking in those losses, you can actually pledge a portion of those assets to secure a loan.
Okay.
So it's a way to access capital without having to actually sell your investments at a low point.
Okay, that makes sense. But how is that different than just like taking out a regular loan?
That's a good question. So the key difference is the interest rates.
Okay.
Remember how we were talking about how after a market crash, interest rates usually go down?
Right.
So because you're borrowing against assets and those rates are low, oftentimes you can get much more favorable loan terms than you would with like a traditional loan.
Ah, okay.
Yeah.
So you're kind of turning that market downturn into an advantage by getting a lower interest rate?
Yeah, you're taking advantage of that.
Okay, smart. But I have to say, I mean, even the idea of taking on debt, even if it's a low interest rate, still makes me a little nervous.
And it should. Debt should not be taken lightly.
Right.
There are definitely risks involved,
Uh-huh.
and it's not a strategy for everyone. You need to have a really solid financial foundation. You need to know what you're getting into.
So let's talk about those risks. What are some of the things that we need to be thinking about? Because I know the source mentioned this term margin call, and that sounds kind of scary.
Yeah, margin call. So a margin call is basically a safety net for the lender.
Okay.
So going back to our comic book example,
Okay.
let's say the value of your comic book collection unexpectedly drops while it's at the pawn shop.
Mm.
They might call you and say, hey, we need some more cash just to cover the difference, just in case you can't repay the loan.
Oh, so they're asking me to put up more money to cover their potential losses.
Yeah, exactly.
Got it.
So in the case of pledging assets, if the value of your investments falls below a certain level, you might get that margin call.
Okay.
And they might ask you to deposit more money or to sell some of those assets just to bring your account back up.
Okay, that makes sense. So really important to understand those risks. But let's say, someone's comfortable with the risks and wants to explore this further. How do you actually manage repaying that debt?
Yeah, so there are a few different options that you can use to repay. One option would be to sell a portion of your investments once the market recovers to repay the loan.
Okay.
Pretty straightforward. The downside of that is you might have to pay some capital gains tax on those profits.
Right, taxes. Always have to think about that.
Okay.
What's another option?
Another option would be to treat the debt like you would like an ongoing expense. So making regular payments on the interest, kind of like you would with a mortgage. And as long as your investments are growing faster than that interest rate, you're still coming out ahead in the long run.
Okay, so it's like a long-term game. What's the third option?
Third option is kind of a hybrid approach.
Okay.
You gradually repay the loan principal, like you amortize a mortgage, over time. That locks in that lower interest rate. And then you may even see some tax advantages down the road, too.
Okay, so different paths you can take, each with their own, pluses and minuses. But I think before anyone runs off to pledge their entire portfolio, it's important, like you said, this is not a get-rich-quick scheme.
No, not at all.
This is about potentially enhancing your returns over the long term.
Exactly. Long game. And it's really important to emphasize, like you said, you need to have a really solid financial foundation before you even think about doing something like this.
Yeah.
Emergency fund, stable income.
Make sure you can pay your bills.
Exactly, exactly. And, no high interest debt. You don't want to be, robbing Peter to pay Paul kind of thing.
Right, right.
And I should also say this strategy is really designed for those diversified investments, those index funds that we were talking about. Don't do this with individual stocks. That's way too unpredictable.
Yeah, so this is about being, calculated, not gambling on individual companies.
Exactly. Be strategic. Be informed.
Well, this has been a really eye-opening conversation. So to kind of recap what we've talked about, those market downturns are a normal part of market cycles. Historically, the market has always recovered from those crashes. And there are even strategies like this pledging asset strategy that can potentially be used to use those downturns to your advantage. But really, the key takeaway here is shifting your perspective from one of fear to one of knowledge and strategic thinking.
Couldn't have said it better myself.
So the next time the market takes a dip, take a deep breath, don't panic. Remember what we've talked about today, do your own research, and think about whether any of these strategies fit into your long-term investing plan. And remember, as always, knowledge is power. Thanks for taking this deep dive with us.